Hey traders, hopefully you're having a great day and you had a good weekend. We're going to be going over some charts today, like always, for the global macro update. First chart we are starting off with is the monetary base for the United States. I'm sure basically everyone who watches this has seen this chart before, but we're actually going to get into not just the United States, but around the globe, how much money printing is going on basically as a percent of the monetary supply for each country. So we can see just this little pump here is around 12%. And let's look at the money supply, the change in money supply within the last 3 months for not just America, but for a lot of other countries. But we do see in the United States, the change in 3 months for the circulating supply of currency is just under 12%. So within 3 months, the amount of United States dollars has gone up over, we can see, 11.99%, basically just under 12%. That's a significant number. Change in 12 months is over 18%. So as time goes on, as the Federal Reserve prints more and more currency, this number will get bigger and bigger. And we've seen that in the more inflationary countries like Venezuela and Zimbabwe, we've seen in 3 months 87%, 48%, and in the last 12 months it's over almost at 2,000% for Venezuela. So we definitely see some potential for inflation with this huge change in the circulating supply. Doesn't mean it's going to happen right away, because we've already talked about the reasons why we think that it will be more deflationary at the beginning and then inflationary later on, discussing the velocity of currency, how it has not picked up, how it's basically dropped off a cliff due to this lockdown. One other thing to note is the central bank's interest rates. This is obviously very important because it kind of sets the price of money. How cheap is it to borrow money is basically the question we're asking. And in a lot of more developed countries, the G7 first world countries, we do see that the current rate is almost at zero, if not negative, for a lot of these first world countries. We see the United States, Canada, New Zealand all at 0.25%. Australia, same thing. And then we even see some countries that are negative. We see Japan at negative 0.1. We see Switzerland at negative 0.75, which is pretty negative. And then we see some less strong currencies have higher percentages for the interest rates. But overall, definitely right now it's extremely cheap to borrow money for businesses, for individuals. So that's definitely going to play a part in the market. So it's going to be a little bit of fundamentals for today, and then we're going to jump right into the charts here. So first thing we're going to look at is the S&P 500. So we did see a potential consolidation and a respect of this descending trend line, but it does look like we broke it. And this, in my opinion, is kind of the final area that sellers could be located. If we see the price break 29.60 or around 3,000, I do think that we could start trending higher to around 31.20, which sounds unbelievable, but yeah, definitely something that I have learned the hard way is when liquidity gets in the market, it has to go somewhere. Stock markets and the economy can be completely detached, and it can stay like that for a lot longer than what I expected at the end of the day. Obviously, the economy is still very bearish, even though we have talks of potential economies opening up and non-essential services starting back up. The vast majority of individuals in the United States are still unemployed and still collecting unemployment checks. So it's still definitely not back to normal. It's not even close to getting back to normal, but there is a little bit of optimism in the United States due to these fundamental factors. So that's a little bit of the S&P. Not really going to trade it. To be completely honest, I'm not super bullish on the stock market just because of the fundamental factors. I'm going to stick out of any shorts. I have been not entering short or anything because of the price action, not really giving us an opportunity to look for shorts in the market. We've seen that this key level of support around 27.60 has been holding really well for a nice strong level of support, and this descending zone here connecting the lower highs did get get broken, we can see on the 6 hour, I still am looking for this horizontal zone of resistance to break before really calling it a breakout to the upside, where we could test that next key level of resistance. This could be a little bit of a fake out, but at the end of the day, it definitely has a lot of bullish momentum, bringing the buyers into the market and pushing the price higher and higher. Breaking resistance is holding support. So it's definitely not, in my opinion, a market to be shorting. It's in a consolidation. You could be looking for potential opportunities for shorts if you do think that the bias is still to the downside. But I think with the strength of the buyers in the market right now within the S&P, it's just not a good time to be looking for exposure to the downside at this very moment. If the momentum does change to the downside, obviously we're willing to jump back in, but it's not just the S&P that's seen some strong movements back towards the upside. We look at the Dow Jones, same thing. We had that nice head and shoulders that was an opportunity. Let's quickly get our snip here and discuss the potential head and shoulders we have. This was the left shoulder right here with the head right here, and this was the right shoulder. The price went above the right shoulder, so now this reversal pattern called a head and shoulders is invalidated. It can no longer complete because the invalidation was when the price broke above this right shoulder. So what are we going to do at this point? Well, I still currently see the market as a consolidation to the side. We got around 23,000 for the key level of support, and we got, let's say, around 25,000 for the key level of resistance. So right now I'm just seeing a sideways consolidation where you have a key level of supply. This first white line is at the 50% fib level, not a true fib level, but this next one is the 61.8. This is a really key area for sellers to be located. So the Dow Jones has not recovered as much as the S&P 500. It's still well below that 61.8% fib, but it's definitely gaining some ground here, going back into the key level of supply. So right now, definitely in my opinion, would be a little bit too early to short. There's a lot of bullish movement coming to the back up to the upside here, testing the highs. So I think at this point it's better to stay on the sidelines if you are short bias. That's what I'm doing. I'm going to remain patient, see what other opportunities the market provides, and if it continues slowly going up, I'm just not going to be really interested in trading this index or these indices due to the fact that my bias of the fundamentals is so skewed from the actual technicals that are being presented to me. All right. So that is the first thing. We're now going to be looking at the US dollar index, which is DXY. This is looking at the strength of the US dollar, comparing it to other currencies. 60% euro, 15% yen, there's some GBP, there's some Swiss franc in there as well. And it's kind of comparing the United States dollar to other major currencies. And we can see we're consolidating. We are forming these lower highs, so we are squeezing closer to the apex, although it's not a very aggressive squeeze, but we're seeing slowly a series of lower highs. We do see some wicks to the upside, showing that there's sell pressure coming into the market. We do see a little bit of these higher lows, although I'm just going to hold on this horizontal zone of support just to kind of create this nice little descending triangle pattern. And what we're looking for is either a breaking the resistance, creating a higher high. We're going to look for that higher low to then create that next floor for the move to the upside. And if we break the support, we'll just be looking for a sell-off. In terms of the fundamentals, I do think that the dollar will weaken over time as long as the Fed prints more money. But if there's another liquidity event where there's a massive sell-off in the stock market, gold, silver, crypto, oil, basically everything, the United States dollar will rise significantly. So that's kind of the question that I'm having right now is are we going to have another massive sell-off, or are we going to slowly climb out of this hole in which we might not have a massive spike again for the US dollar? All right, so that's the United States index and dollar. We're now going to get into gold and silver. So first thing we're going to look at is gold. Let's go back to the 6-hour chart. We had that nice squeeze here. I just put a really large projection zone, but at the end of the day, it was a nice squeeze. We got a solid push to the upside, hitting around 1765, 1764, somewhere around there. And then we got a pretty aggressive back move to the downside in line with silver. Silver had a similar move, but in my view, this is not to worry about if you are a long bias trader or investor in gold. It is retesting the previous key level of resistance we saw at 1730 back in mid to later April. So in my personal view, that was a strong impulse push to the upside, and this is a nice pullback, and it's going to be an exhaustive move, and I think that we could be completing this exhaustive move, and we will potentially have another move back to the upside where we have a key level of resistance at around 1785 to around 1800. Let's first look at this structure, and then we'll get into another structure that's on a larger time frame within the same asset that, in my opinion, looks somewhat similar. So we see a massive sell-off, and we're looking for something of a reversal around the 1730 zone. Let's first look at the 15-minute, and then we'll look at the 5. So first thing we did is potentially draw a little descending wedge here. That was the first breakout where we had the squeeze of the descending wedge in line with the horizontal level of support at 1730. We did get a move to the upside. Let's now jump to the 5-minute chart. This is a very small time frame that we are looking at, but it does, in my opinion, provide a really good overview of this potential reversal here where we got a downtrend, consolidation, and now potentially to an uptrend continuing the bullish momentum. So let's look at how this played out. Initially, obviously, we got a lot of movement to the downside, a lot of sell pressure coming into the market. We see 1, 2, 3, 4 rejections off a descending zone, and then we see 1, 2, 3 supports, series of lower highs. So now we got a nice descending wedge, which is a little bit more bullish as long as you have a nice support holding, but you do have to be a little bit careful because you could just poke out that way and then continue the downtrend. So you want to make sure that you're holding some level of a support, and that's exactly what we saw at that 1730 zone. We did get a wick and a rejection pretty quickly there, and then you saw 1, 2, 3 supports hold, so that was 3 times at the support hold, and then it poked and broke out of this descending wedge right here. That's the first indication that buyers are now in control, taking over the market, and going to be potentially looking to hold that support yet again. So then we got a little poke to the upside. We did not get much continuation from the buyers to push the price up. We were holding this nice level of support at around, resistance at around 1734. It was initially a support, which turned into a resistance once, twice, 3 times, and now it's 4 times. So this is a very strong horizontal level of resistance that we're currently seeing, although right now we have seen this descending wedge break to the upside, and then we retested the support, 1730 support yet again. So we broke, retested, and held that zone yet again. So in my opinion, now we've confirmed this as a key level of support in my view. So the 1730 zone is a strong level of support, and we've already broken one descending zone. And if we're able to break this next descending zone, let's just take away this. We got first anchor is going to be right here. And then you got your second major anchor, and then you got 1, 2. So you got 4 different rejection points on this descending trend line, confirming that this is a pretty important zone on the chart, and we've already broken to the upside. So now what we're looking for to confirm this shift back up to the upside would be a break in this horizontal resistance, which will be around 1733. This major level right there. If we're able to break this zone, this 1733 zone, I think we'll have a pretty strong chance of continuing back to the upside. We do have a minor level of resistance at 1742, although if the price does start to push back and carry its momentum to the upside, I think we could get an aggressive move back up to around 1760 and then continuing back to its major long-term target at 1785. So that's my overall analysis for gold, and I'll have a quick overview of a similar type of structure that occurred on gold. We had a massive sell-off. We had a nice tight support get created with a nice tight consolidation, which is like a volume accumulation phase where you're seeing not a lot of volatility. And then once you get to see the price break a series of resistances and holding supports, then you definitely see a potential shift in the trend. So now let's look at A similar type of structure that occurred on gold, where we had that massive sell-off. This is the structure right here. So this is back when we had that liquidity event where basically all assets sold off across the board. We got that massive sell-off. This is that high of 1700. And then initially, let's get our snip and discuss this. So we already saw and talked about what we currently see within the market, and this is what we could be expecting for a move. So obviously this is a lot of sell pressure, and then you start to see a bottom form where the low is not able to push towards a lower low. So first thing, you got a massive move to the downside, lots of pressure and aggression to the downside. You saw a bottom form where you saw 1, 2, 3, 4, many times where the support not only held but rejected the price back up. That's when you're looking for a potential descending trend line to connect the lower highs. There's one right here, 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 and then you just connect that zone right here. It's not perfect, but there you have a horizontal zone of support and a descending zone, and the price pokes to the upside, breaking the resistance, giving the confirmation that the bulls are now looking to enter the market. The bulls have a little bit more confidence because they're able to hold the support and push the price above the key level of resistance. And not only that, you get another attempt where initially you had this descending zone, and then you can also incorporate another descending zone to give even more confirmation. And this is what we're seeing right now. We already had one zone break right here, and now we're looking for the second zone to break. I think once that second zone is broken, we have that nice break above the horizontal zone, which would be around here on this chart. I think we'll have something similar where you get a very aggressive move from the bulls to push the price of gold back near to the high that we saw before the massive sell-off. So that's my view of the market. I'm pretty bullish on gold. We've already talked about how much money printing is going around the globe, not just in the United States, but in short, it's a lot, so we are long biased gold and silver. So that's my view of the current market. We got a nice breakout move to the upside, and I think we could get a little bit of a reversal or some level of consolidation holding this 1730 zone, where it does look like we do have some buyers starting to enter back into the market. And then once we pass that 1733, 1734 zone, I think that's when we may start to see some real momentum coming into the market after we validate this previous key level of resistance on the small term time frame into a new level of support. All right, now let's look at silver. Actually, first, let's look at the gold and silver ratio because that is very pertinent, and then we'll look at silver. So I did draw in this potential descending zone connecting the lower lows as a potential level of support. It does look like it completely broke that all together, and it's now just going towards the 100 mark, meaning that for 1 ounce of gold, you can buy 100 ounces of silver, or it takes 100 ounces of silver to buy 1 ounce of gold. Pretty psychological zone, but let's jump back all the way to the weekly and just take this off. The main area of resistance for this ascending wedge would be around 95, although this $100 level is a pretty significant zone just because it's such an important number within a chart. It's first number in double digits. Definitely 50s, 100s, 150, around those is a pretty important psychological zone. So we're getting to that right now. Obviously, we've just absolutely fell off a cliff when we passed 108. So I think it could still keep on going. It doesn't really seem like it's halting too much. We are getting a little bit of a consolidation here, but not too much. We did see that there was a little bit of resistance before we absolutely mooned to the upside here. So not surprising that we're getting some level of hesitation to go back down. But basically, definitely still looks pretty good for silver, where gold and silver could both be going up, but silver is just going to appreciate at a quicker speed because this is just representing the relationship between gold and silver, where we're taking out the US dollar because that's just one way of valuing a certain asset. Not everything has to be valued in the United States dollar. All right, next thing we're going to look at is silver. So let's go back to the 6-hour chart here. We had a massive move after that nice descending wedge, pushed to the upside, breaking the previous resistance here, holding for a nice new level of support. Great move all around. Now, we hit the $1750 zone, which is a key level of resistance. As we can see, next level of resistance is around 1450, and then the previous level, which is going to be our new support, is around 1650. So we got some nice even zones that we're currently holding for resistance and support in my personal view for silver, and we're just in a nice consolidation. It has to happen. You can't go from point A to point B without any sort of consolidation. Even in the biggest bull runs, you're going to have pullbacks to let the bulls breathe, to let the market take a breath. So I think that's what we're seeing right now. I'm not really looking to do much more. Pretty happy with this overall move so far. It's looking great. It hit that 1750 zone just like we were anticipating for the next level of resistance after it broke 1650, and it's just in a nice consolidation. As long as the gold and silver ratio is continuing to the downside, I'm very bullish on silver. I am bullish on gold, but I'm very bullish on silver. The small time frames don't look as good as gold. I think the small time frames on gold on the 5 minute for that reversal does look pretty good. And I think if gold starts to climb back up, you'll see silver go back up even more aggressively than gold due to that gold and silver ratio being so weak and really having a lot of momentum to the downside. So in my personal view, it does look pretty good for the metals. Still pretty happy with the overall move that we've had, but I do think that there's still a lot to go for a potential kind of full extension from this major squeeze that we've been looking out for a while. So overall, pretty bullish still. Not going to be super bearish or anything, because obviously we are still able to hold this nice new level of support, which is a key previous level of resistance. So if you think you missed that first entry, this might be a good opportunity if you are looking for that nice reversal. Obviously, if we do break the 1730 level of support, that would invalidate this potential reversal, and then we would have to basically either look to see if it bounces back up around here, where we might have a nice minor level of support. We don't exactly know, but if it does break this 1730 level of support, it's going to look a little bit less ideal, but my anticipation that it is still going to be potentially holding this zone. So that's my thesis. That's going to be how I'm going to be trading, and that's my analysis for gold. So that's going to be basically the video for today. We went over the SPX, the dollar index, the gold, silver, and gold and silver ratio. If you have any questions, drop them in the comment section below. Definitely some interesting stuff happening in the markets. SPX, I'm definitely a little bit surprised that it's still continuing to the upside, but like we said before, the economy and the stock market are completely detached from each other at this point in time, where obviously the economy is not doing great. It's really taking a big hit, but the equities market is absolutely soaring. So, obviously, the quote goes, the market can remain irrational more than you can remain insolvent. And at the end of the day, as a trader, you are needing to manage risk more than be right. So, yeah, I got out of there. I'm very all right with that. Took a little bit of a hit, but that is life. I do not mind. I'm willing to stay patient for this next trade here to either capture some opportunities that will push the price to the downside, although as the weeks go by, I'm getting a little bit less and less confident about this as the days go by, because if you can print unlimited money to keep this up, that's basically a rigged game. You don't really have a chance shorting something if the federal government and if the Federal Reserve is able to purchase unlimited amounts of an asset. It's not going to go down. It's going to devalue the dollar, which would be really great for gold, silver, cryptocurrencies, which we have exposure in. But at the end of the day, for this particular trade setup, I think if we continue to see the Fed just print more and more and more and more money and keep interest rates at zero or even negative, I don't think we're going to see that massive sell-off that we are anticipating. But if we do see the central banks start to raise interest rates and make money more difficult to acquire, it will be difficult for basically for me to believe that the stock market will continue. But basically, in short, if there's cheap money, the stocks will probably rise. If money becomes harder to try to get with the rising interest rates, if they do raise them, then you will probably start to see a sell-off occur. But what the main thing we're looking at now is liquidity. Basically, there's going to be no real correlation between a falling economy and the stock market at this point, in my view. So now all we're looking for is there a lack of liquidity in the market? If it's a yes, then there's a chance that we could see a significant move to the downside. But as long as the Fed is providing unlimited liquidity in the market, I don't think this market is going to go down. I don't think this asset is going to go down to what we want it to have favorable risk-reward parameters for us to enter that trade. That's my personal belief. It's definitely a rigged game. If you are a person who thinks that shorting is a natural part of the markets, SPX, I don't think, is a prime opportunity to be looking for short opportunities. Looking at markets that are less manipulated and less rigged, I guess you could say, it might be a better move. So that's going to be my thesis for this next little bit here. Doesn't mean it's never going to fall down, but with the Fed basically just being able to print unlimited amounts of money and buy whatever they need to keep it up, you're basically fighting a behemoth. You're basically fighting a person that has unlimited power, to say the least. If you have control over how much currency there is, well, that currency is used as a global reserve currency, that it's accepted everywhere, you are fighting an absolute beast, and you will never win that battle. So that's going to be my takeaway from that particular trade, and for the month of April, basically. So every single trade you should learn something, or else you're not really advancing. So hopefully you learn something as well. I'm going to be a little bit more skeptical of any shorts within the SPX, SPY, Spider, whatever you want to call it, because at the end of the day, we're looking for a lack of liquidity, not a disruption in the United States economy, because like we said before, they're very two different beasts. So thank you very much for watching. We really hope you enjoyed the video. If you have any questions, concerns, thoughts on what we talked about today, definitely don't be afraid to put them in the comments section below. We love people who, give us some thoughts on what they think and stuff. We really kind of appreciate it, get some engagement going. And if you think that this information was useful, it'd be great if you subscribe so you can get more information like this for the next time. So thank you very much for watching, everyone. Until next time, have a good one.